All right, here we go. So today's workshop is on how to find options day trades. If you've been in premium this year, you know that's kind of been the main thing I've focused on for the most part, apart from this rally the past month or so. When the market's just tougher to overnight stuff, I think that's really the easiest way to make money in the market. But just because it's the easiest way to make money in the market doesn't necessarily mean that it is easy. It takes a lot of skill and practice. And I'm just going to talk about some tips and my overall process with finding option day trades and just a little bit of how I go about them after I do find them. So to start, the main things I'm always looking at in terms of options day trades, because of liquidity, because of popularity, because of just how the options chain work and how the actual indices are represented, is the SPY and the QQQ. They probably are the most traded takers in terms of options intraday. They give you a lot of flexibility on the expirations as well. And I just feel like the technicals work well on them. So every single morning when I'm looking for trades, I always start off with the SPY and the Qs. Now, my process always starts maybe a day or two before because I'm looking for the overall trend in the market. So I'm already looking and already have an idea of what the daily and the 4-hour charts look like. That gives me my overall bias. However, I'm not trading those timeframes, day trading intraday. I'm not really looking at those timeframes, but I still want to understand how those timeframes look, just so I have my bias and also for the bigger levels. For an example, having this 4-hour cup and handle could have allowed you to take a day trade right off of this level, this larger level. So if you saw in the 4-hour that you were back testing in previous resistance and flipping it into a support, then you could go down to the 4-hour or the 1-hour, the 15-minute, the 5-minute, and then you can get your variables for a day trade. But you want to make sure you're still mapping out the larger levels, have those set up, set alerts around those, and start off with those. After you've kind of already created your bias, and that should have taken place before the market even opened, that's when you can go down to your lower time frames and look for patterns and stuff. So I already have most of my levels charted out. One thing that's also very helpful is charting out your 15 and 5-minute levels before the day even starts, because if you're kind of running around trying to chart out your levels in the middle of trades, you might not pick the best levels, and picking levels is probably the most important part about day trading. It's going to allow you to find the best areas to buy and to sell. So I make sure all my levels are charted out. After that point, the next thing I do is I look for patterns. So I'm looking for wedges, I'm looking for cup and handles, I'm looking for head and shoulders. And typically, if you're day trading, those patterns really won't develop, at least on the 5 and the 15-minute, until at least an hour into the day. Especially on the 15-minute, it could take a few hours for those patterns to develop. So sometimes if I want to trade the morning session, then I create that 5-minute and that 15-minute plan the day before. I set up my pattern. For an example, let's say like right over here, there was like a little bit of a wedge developing and I wanted to trade that into the next day. I can set up my patterns for the following day, but if there is a large gap in the morning or even a large spike right off the open, I kind of step away from that. It's very hard to use the previous day's price action going into a new day if you get a large move before or at the open. So the only times that I will trade right around the open is if you get a very quiet open and you already have a pattern set up or a level that you're testing. So assuming you do, that's when I would trade the morning session. However, most of the time, if you do get a large gap, one of the main primary moves I wait for is just a gap to fill. And if that gap doesn't fill, for an example, let's say you gap down and you just keep heading lower, then I might just look at it as a completely new price action. But if it's not a large gap, but it's still large enough of a gap that you can't trade the open, I want to wait to see if the gap will fill. However, I typically don't trade the move to the gap fill because it doesn't always fill. A lot of people see you gap down and they jump right into calls until you fill the gap. That will work sometimes, but the days where you never do that, you can really screw yourself over. So typically a lot of my day trades on the SPY and the Qs are focused around 12:30, 1 o'clock Eastern time, maybe a little bit after. I wait until that gap fills and then maybe I play the reversal off of that. For an example, if you gap down, like you could see over here, it gapped down and then you run back up to fill that gap, I might take puts off that. That actually was one of the alerts this week and it played out. And then let's say you gap up like you did over here, I'll wait until that gap fills and you could have played calls right over here, at least for a small bounce. So one of the primary moves I always, not always trade, but one of the primary moves I always look for in terms of trades is when the gap fills to play the reversal. Now, apart from that, even if your gap doesn't fill or even if there is no gap, one thing I look for is just the overall pattern to develop. So it could take 3 hours, 4 hours, but typically you get some sort of pattern on most days in the market, whether that's a rising wedge, a falling wedge, any sort of pattern. Once you get a larger pattern on the 5 and the 15-minute, typically there's going to be a lot of other people also looking at the same thing. So for an example, maybe something like this over here, you had this wedge develop. I'm sure a lot of traders played this breakout right over here. If that didn't break out, maybe you would have broken down something like this, and that could have set up a put trade. So looking for those larger patterns to develop also helps. And apart from that, it's just the standard stuff. I don't really want to spend too much time talking about variables. You look for divergence, you look for levels, you can look for the VWAP. That's another big one. A lot of trades can be taken off of the VWAP, whether it's a rejection of the VWAP, a break through the VWAP. That's just, I use it just as any other support resistance level, except I'm looking at it pretty much all the time. And a lot of the times if I take calls well under VWAP, I might look to take profits at VWAP. If I take puts well above VWAP, I might look to take my profits on those puts when you fall back to the VWAP. It's just a good equilibrium level that you typically test a couple times a day, if not more. So those are really what I'm looking for on the SPY. The Qs is relatively the same exact thing, but I look at both of them at the same time. And a lot of people ask me, how do you determine whether to play the Qs or the SPY? Typically, I want to see whichever one has more volatility because I want to get a larger percent return. So let's say there's a day where the SPY is down 0.5%, but the Qs are down 1.5%. I might actually gravitate towards playing the Qs on that day, whether it's for calls or puts, because there's more activity there. And I'm looking for the larger moves. So typically I'm going for the one that gives me more volatility. And overall, most of the time, they're going to have very similar variables. So it's just the level of movement that's going to be the main focus, which determines which one of the two I trade. There are also certain times when you have events in the market, like let's say large cap tech earnings or other things in which the Qs are more affected than the SPY, or the SPY is a little bit affected. Like for an example, you could have a bad day for the overall market, but it's a good day for tech and vice versa. So those are the small things that change whether I trade one of the two. Overall though, they're about the same. Nothing between the two is really that different when you're looking at the price action intraday for the most part. And then there's also the small caps, the Russell 2000. In this market condition, I very rarely will trade Russell 2000 calls or puts intraday. I just feel like it's a little bit less reliable with the technicals compared to the SPY and the Qs. I feel like it's kind of just following everything else, but it does have its slight differences as well. So I look at it, and typically the main reason I'll be looking at the Russell 2000 intraday is if I'm like trading some sort of small cap options, or not even small caps, but even sometimes like I'm trading AMC or GameStop, I'll look at the Russell 2000 as well just for more confirmation. But I prefer to trade the Qs and the SPYs intraday over the other two. Now, apart from the indices, let's say I can't really find a trade off the indices. I wake up in the morning and things just really aren't looking that clear to me. The next thing I'll go to is mega caps. So I'll start off with this whole entire watch list over here. I already have a few names that I like to look at. I like to look at Meta. And I'm doing the same thing. I'm looking for patterns. I'm looking for whichever variables it is. That's not really the purpose of this workshop. It's more about how to find them. So let's say I have this whole entire list of large caps. I'll go on my 15-minute time frame first. I'll try out all my levels on all the large caps. I'll look at my 5-minute time frame, and then I'll see which one is developing a pattern. Also, you can look for stocks that are kind of moving against the market. Like there's certain days where the market's down, but Amazon is up 1%. All those little things, they stand out to me, and that's really what I like to pay attention to. So I look through pretty much all the large caps, and right before I take any large cap trade, I still try to get some sort of confirmation bias from the SPY or the Qs, most likely if it's a large cap tech from the Qs. So I want to also make sure that I'm not getting into, let's say, Tesla calls when the Qs are looking very bearish to me. I want to make sure that you have a little bit of at least neutral. Like at worst, Tesla, I'm bullish on it intraday, but the Qs is just neutral. But if I'm bullish on Tesla intraday and bearish on the Qs intraday, I'm not going to take those Tesla calls. So you also want to make sure you're getting confirmation bias with that. Also, you have certain days where you have a very strong market. Let's say the Qs are up 3%, but they start to just become quiet. They just start to consolidate. And it's really hard to get a trade off on the Qs as, like, let's say it's around noon and you had a very good morning, but then you just started going sideways. That's also another point in which I'll start looking at the large caps to trade, whether it's calls or puts, because you might still get some more activity in some individual names. Now, I'm not trading all of them. I'm just looking again for the ones that stand out. Like, let's say the market's just kind of going sideways, but you see Tesla's still going up and down quite a bit, or whichever name you're looking at. You really just want to look for something that stands out, because one of the main things when it comes to day trades is you want a movement. Even if you're wrong, you can manage your risk and get out, but you're looking for volatility in a sense. And a lot of these stocks overall are not going to really provide you intraday volatility if you're just trading common shares, unless it's with a very large size. But even with percent changes, 1-2% move could be a good enough move for a large cap. But for most people trading common shares, you're not really looking for that return intraday. You're looking for a much larger return. And that's where the options can come in. So I'm looking through all of these timeframes and everything. And typically I'm just doing the same exact setup. I'm looking for contracts that are scalable. To me, that's another big thing. You want to make sure whatever you're trading, you can get multiple contracts of. It really does not make any sense to be trading one contract on anything. It just limits you too much in terms of being able to scale in or scale out. And it makes you have to be a lot more perfect in a market where you cannot be perfect. So you want to make sure that you're trading something that gives you the flexibility to have a lot of contracts. You can go further out in your strikes and closer in expiration to make those premiums cheaper, but you also have to understand that does increase your risk to a certain extent, especially when you're getting closer to the expiration time. So you want to make sure that you're being comfortable. Don't trade something that's too expensive for whatever your position size is. And then also the reason why I've kind of stopped trading a lot of small caps intraday is because you're going to get very weird movement on the options themselves. You can get like something on like Clove. The stock price might go up like 2% and then the options like don't move at all, or vice versa. Like you could just not move at all and then your calls are down like 10% like out of nowhere. So you want to make sure that the price action is very easily reflected on your option premiums as well. You're looking for things to be easy in terms of how things are moving. Your main job is to just find the move. But if you're also having to worry about why are my options not moving the way I want them to, I can't get enough contracts, whatever it is, you're most likely in an unfavorable position and it's going to cost you in one of your trades for sure. So that's another thing I like to stay away from. Make sure you don't fall into any of those errors, because it might be fun to see other people making crazy gains, but they don't really talk about the losses when it comes to trading those kind of just weird tickers intraday. You just want to stick to something that you're familiar with and that you can just focus on the price action rather than only the contracts. Really, the contracts are just your tool to make money. All your focus for the most part, after you've already learned about how to get the right contracts, is just looking at the price action, making sure that lines up. I'm just looking at my notes right now. So we already talked about the SPY and the QQQ mega caps. While I don't really trade small caps for the most part with options. However, that does change if you do have these certain seasons where you get a crazy move in small caps or even just meme stocks. Those are the times where maybe I will trade them. But again, it's only when things are really standing out. Like let's say GameStop is in this range right over here. For the most part, I very rarely will trade GameStop options anymore. But if I see that it's in this very long-term range and it's looking for a breakout, that might be a reason as to why I'll trade it. But you need to have a reason. There should be a reason why you're going out of your typical boundaries in order to trade something that you usually don't trade. You shouldn't just be doing something like that out of the blue. Now, another thing I want to talk about is looking at options flow. So you can use whichever platform you want. This is TradyTix. And again, I don't really do this too much on small caps, but for large caps, let's say you're looking for out of the money and short-term expirations, you're trading weeklies, you can put in pretty much any ticker you're looking at. And you can also see the flow, which way is it going. This again is just another form of confirmation bias. I never trade solely off of flow. I know some people do. Typically, I'm just using this to see if other people are seeing the same things as me. And the main thing I'm looking for when it comes to flow, when I'm already in a trade or I'm looking to get into a trade, is the timing of it. I don't care if at, let's say, let me look for a good one over here. I don't care if like really earlier in the day, there was like a $7 million call buy. Like let's say at 10 a.m. there's a $7 million call buy on Meta and I'm getting into calls at 2 p.m. All I really care about is what like the last hour or so the flow looks like, especially if you're trading the SPYs and the QQQ. You can look at the market net flow. This will give you an overall idea of where the money is trending to in terms of calls and puts on the SPY intraday. Well, this combines net premiums from all stocks and compares it against the SPY's price. So this will just give you an overall idea of what other people are doing. And you don't want to put like so much thought into that. Sometimes the crowd is wrong. The crowd is not always right. But if the timing works with you, that's when it makes sense, right? If the second that you're seeing all the variables for calls, or within the few minutes that you're seeing all your variables for calls, you're seeing a large spike in the overall market net flow for calls, that could be the same confirmation bias that you need. But don't take it to the point where you feel like you have to do what everybody else is doing at all times. You're really just looking to see if things match up with you or not. And if they don't, typically some people, they just do the opposite then. They're thinking about getting into calls, but then they see all these puts are going up and they're like, maybe I'm the one that's wrong. I should switch into puts. And yeah, you might be right. But typically when there's that sort of contradiction in any manner, I just don't trade until there's the next move. If you're seeing something that's going against what you want to do, it doesn't mean you have to do the exact opposite. Those are typically the periods where I just sit on my hands and wait because there's going to be a new pattern that forms in an hour or 2 hours. But you can't force yourself to always take a trade at a certain point. That's when you're really just going to be forcing trades and you're not going to be as consistent. So when it comes to looking at flow, I really just keep it that simple. Sometimes if there's really nothing to trade and I'm just looking for ideas, I will just look at the overall flow. I'll look for things over $1 million in premiums, out of the money, short expiration, and non-ETF, because you're still going to be getting a lot of those types of orders with ETFs. But if we put in non-ETFs, you can see on Friday there was this big call that came in for BURL. This was around the market close. Maybe I'd look at that for a little bit. But again, if the contracts and the actual stock itself don't really make sense for how I want to trade it, then I'm just going to overlook that. But those will give you like maybe hidden gems every once in a while. Next up, I want to talk about picking expirations, especially with the SPY and the Qs. You're going to be getting, I think they're extending it now for most people where it's like almost every single day. There's a lot of choices when it comes to expirations. It really depends on how free you are. If you're playing anything that's expiring on the same day, you really should be staring at your screen at all times. And a lot of people have made a lot of money from 0DTs. They do give you a lot of potential, but you have to understand that the risk is that you can lose every single dollar that you put into it. So when it comes to picking expirations, again, if assuming that it matches my position size for 0 day till expirations, which is always going to be smaller than something like weeklies or 2 or 3 weeks out, it'll be something I'll look into. You also want to make sure that the further the day goes on, you're not staying in that trade for too long. If you're in 0DTs, you should be looking at it as a quick trade. It should not take more than half an hour of being in those 0 day till expirations, because even if you're right, that time decay is really going to be working against you. And again, you want to be in a position where the odds are in your favor. You do not want to be playing a losing game. It's very easy to turn this from trading into gambling, especially when you're trading something that's moving so quickly. So you have to make sure you're tailoring the expirations of your contracts to the type of trade you're taking. If I expect my trade to last more than an hour, I will go further out than 0DTs. It does not make sense to be thinking that the move is going to come in 2-3 hours. Even if it does, it's not going to probably be as worth it as you thought it would be. So if you think your move is going to take longer than an hour or two, it makes no sense at all to be trading 0DTs. I see people doing this way too much. Where in the morning, let's say you gapped down and you really feel like the gap is going to fill at some point during the day, and you immediately get into 0DT calls. You put your strike price as the gap fill level. A lot of newer traders do stuff like this, and it just doesn't help you out at all. You'd rather extend your contracts a little bit, be safer rather than sorry. Yes, you might be limiting your potential profit, but you can always be increasing or decreasing the size of your contracts. Everything is relative. You do not need to severely increase your risk and make your trade more difficult just because you have a stronger bias on something. You can always give yourself more room in terms of how the options are moving. And if it starts to look like it's going in your way, you can increase your position size a little bit. Nothing that's too risky for you, but something where you feel happy about the profit you're making. You still want to make sure that you're enjoying the profits, because if you're making profits consistently and you're not feeling it, you're going to start tempting yourself to really start putting in more money or to look for larger percent returns. You don't want to be forcing yourself into any trades that you shouldn't be taking. So you want to make sure that your expirations make sense for the length of your trade. Again, I've already talked about a lot of this stuff, so I don't want to go too in depth with each specific thing I'm talking about today. And then in terms of strike prices, you also have to do the math. Let's say you're trading 0DTE SPY calls and you're getting $400 calls an hour before the close, and the price is right over here. If you look at that from a percent move, that's a 1% move with an hour. The likelihood of that happening 9 out of 10 times is very low. So you want to make sure that you're giving yourself strikes that are not too far away, right? If they're too far away, it's really going to work against your favor the later the day goes on. So you want to make sure it's okay to go out of the money with 0DTs. Those can actually really multiply your profits a lot quicker, but you're not going to be going too far of the money, especially the later the day goes on. Typically, if I'm trading calls or puts 0 day till expiration, I say at the money kind of, because you're already getting close enough to the point where your profits are going to be multiplying the deeper in the money you go. But the second you start reversing trend, whether it's calls or puts, you're going to see a very quick drop in those premiums. So you want to make sure you're giving yourself some room to be wrong as well. So you want to make sure you're checking the expirations, you're checking the price of the contracts, making sure they're scalable. But another thing a lot of traders mess up with is they're combining a lot of different things. And I'm somebody who's been at fault for this in the past as well. Let's say you're trading SPY calls intraday, and then you're also taking Tesla calls and Apple calls. Let's say you see a falling wedge on the SPY, you see a cup and handle on Apple, you see a bullish harmonic on Tesla. There three, a lot of people will say that these are three separate patterns, so it doesn't really matter. And they won't trade something like a wedge on Tesla, a wedge on SPY, and a wedge on Apple at the same time. But if you get different types of patterns on the three of them at the same time, some people will be inclined to trade something like that. That is still very risky because overall the likelihood of them moving together is the same. So yes, if you're right, you'll make triple the profit, kind of. But if you're wrong, you can lose a lot more. And you need to start thinking more towards the risk side as a day trader than the potential profit side. The risk should always be the first thing on your mind. So you need to look at your overall position size as just long or short, especially when you're trading the tickers that relate to the indices that you're trading. If you're trading the Qs, and you're also trading Apple and Tesla contracts, really at the end of the day, all you're doing at that point is just increasing your risk. You're just doing the same exact thing, but with other tickers. They're probably going to move the same. And it's not your job to think about, oh, what if it doesn't? What if it helps me out? And the Qs go up, but then Apple goes down and I get Apple puts and all that type of stuff. You're just going to mess yourself up. You're going to step on your own foot. You do not want to do that. It's not about being right all the time. It's about making sure at the times that you're wrong, it doesn't bite you. All right, so you want to be focusing on also making sure that if you're trading something long intraday, you just stick to that. Trading something short, you stick to that. Hedging is always, of course, it's okay as long as you're managing it correctly, but you want to make sure that it's done in the right manner. So those are kind of how I go about things overall. Another way sometimes that a lot of people find day trades is with the runners. A lot of people look for those crazy pre-market runners like the bio stocks and all that type of stuff, where there's some sort of lab report that comes out and the stock's up like 300%. I know a lot of day traders look for stuff like that because of the heavy volume. I never trade options on things like that. I really don't trade those things in general just because of the risk. But trading options on those types of names is very risky in my opinion, because you can get a lot of halts that can screw you up as well. Also, just the overall volatility takes away from the technicals. So a lot of traders, when they're introducing you to day trades and trying to make a lot of money, they're going to tell you to go look for the stock that's up 200% and maybe short it or maybe long it or whatever it is. As an options day trader, you're not looking for the thing that's going super crazy. You're looking for a consistent ticker, which is why I think large caps are what I gravitate towards, a consistent stock, but it's showing you some sort of new variables on the given day. So it's not the type of stock that's going up 200, 300% because of some news that comes out. But it is the type of stock where you can get a 2-3% move and make that a 300% move on options. You're allowing yourself to trade a safer ticker, but make the same amount of profit. And a lot of people start to think, what if I start trading a ticker that's already going crazy, 200, 300%, and then I do it with options as well? Wouldn't I just be really increasing my profits? Sometimes maybe, but the IV is also going to come into effect. And there's going to be a lot of other traders trying the same exact thing. They're going to be trying to get out at the same time. It's really going to mess up those prices. You want to be using options as a tool to leverage your money in a safe way. And leverage in general can be a very dangerous thing. So if you're not checking off all of these boxes one by one, you're gambling. That's just what it is. You are gambling. So you want to make sure that you're managing everything together at the same time. And this comes with practice. That's why I preach paper trading so much. You want to make sure that you're covering all of those boxes. Moving back into finding the actual day trades, let's say on something like the SPY and the Qs, you want to go back over to that 5-minute. Another thing that's very important is making sure your levels match up. So let's say you have a 5-minute resistance level. Let's call out this 397.6 level. This is a 5-minute resistance from this high over here and this high over here. So let's say you entered calls on the VWAP and you're looking for this move to pretty much happen. Not only should you be charting that on your 5-minute, but you should also be looking over to your 15-minute, making sure that level is clear, and also looking for additional touches. You can see, if you zoom out, you can see even more touches on that level. Those are the types of levels that you want to be trading around. The levels were on the 5 and the 15-minute. You can see that level is being respected short term, right? Because there's a lot of levels where in the past, they could have worked out very, very nicely. You can see if we really zoom in over here, the same exact level, all the way back over here was held as support on September 13th, right? So there's going to be a lot of levels which are historical levels that worked out in the past, but sometimes those levels mean nothing in the present. You want to make sure, and this is something I don't really talk about because when it comes to swing trades, all you're really looking at is the historic levels. But on the day trades, you want to make sure not only is it a historical level, so you get more bias from other people also looking left on their charts, but you want to make sure that level is being respected short term as well. So you have to make sure you're using the 5 and the 15 minute to chart out your larger levels. VWAP is another big thing. Bollinger Bands, I don't really care about Bollinger Bands on the 5 minutes because typically with this level of market volatility, you're just going to be going up and down the Bollinger Bands all the time. But on the 15 minute, as a reversal trader, a very consistent trend that I see is the same exact thing, getting puts off the top, getting calls off the bottom. It does work out quite a bit. So for an example, right over here, you're back to the top. Maybe you run up a little bit more into that 397.6 resistance that we talked about. At that point, you get like classic bearish divergence or something. That's when you can start to spot out the variables. But you want to make sure you're using the two of them together. And then when it comes to breakouts, like larger levels, the only time I'll use the 1 hour chart as a day trader is for confirmation for candle closes. So really the only thing I'm looking at when it comes to the 1 hour chart intraday is where the candle closed. You can see this blue zone right over here is very important. And the fact that this 1 hour candle closed slightly above it, I think gives more bias to the 5 and the 15 minute time frames for calls. So where the 1 hour candle does close and the 1 hour candle that you get can be very important. For an example over here as well, you gapped down. That was a bad move. You broke support, but your 1 hour candle showed that during that 1 hour, you were still able to hold gains into the full hour. Same thing on the next hour. You did back test it, but where did you close? You closed halfway back up. Then you got a bullish engulfing candle. Look at the large green candles showing up one after another. This gives you more bias that your trend is headed up. Even when you get the pullback candles, you're following that up with good hours. An hour as a day trader is a very long time. And really, it's not trading the 1 hour candles. It does not make sense to be trading 1 hour candles intraday. But seeing how the candles close can give you your bias for the next trade on the 15 minute and the 5 minute chart. So that's another thing I'll be looking at. Also, I talked about earlier in this workshop about how going into the next day, you can set up some patterns. This is a time frame where you can do that. You can set up this 1 hour pattern going into Monday, and you can see that you're testing a breakout, and this can give you a slight bias to look at the 15 minute and the 5 minute again for calls. But your higher time frames are not where you're trading. They're just giving you bias and confirmation. You're trading the 15 minute and the 5 minute, or even lower if you're trading a very short trade. So those are the time frames I'll be looking at. That's how I kind of go about picking the levels, making sure they work out historically, but they're also being reacted to short term. In terms of the oscillators, I do find the RSI to be a little bit misleading on lower time frames. It can be overbought for a while when you're in autopilot mode on the SPY. It can be oversold for a while and you can keep dropping. So I'm not too concerned about the RSI on the 5 minute time frame. The 15 minutes is a little bit better to me. Divergence is something I used to use a lot as a day trader. I don't use it that much in this market condition just because there's so much news coming out all the time. Divergence, in my opinion, is really an indicator that works best when you're just having natural price action. When you're not getting a lot of gap up and gap downs, when you're not getting a lot of news, when it's not earnings season, when things are nice and quiet and you're just getting consolidation periods, the divergence is a little cherry on top that can tell you if something's about to break out or break down. It's really something that as a day trader, I just use when everything is calm. When the waters are calm, I'll look at my divergence. But when things are going crazy and you're already getting price action, it just kind of gets thrown out the door. You can get really good moves on calls while you have bearish divergence and vice versa. So typically divergence, that my main reason I use that so much is for swings, not really so much on day trades, unless, like I said, the market is calm. Apart from that, a lot of people do use EMAs. I used to use them a little bit. I only like using EMAs intraday for continuation moves, like riding the 9 EMA is something that a lot of traders use as well. But I don't really trade reversals off of the EMAs. Mainly the only other indicator I'll be trading reversals off of is the VWAP. That probably is the most consistent day trading indicator in my opinion. It's very simple. A lot of other people use it. You see a lot of tests of the VWAP. You can see the whole entire day the SPY was just reacting to the VWAP until it broke above it, and then it flipped it into support. This yellow line right over here. So the VWAP is another thing that I also use with my levels to take profits at or to buy at or whatever it is depending on the type of trade. And then finally, I also want to talk about volume. In general, higher volume is something I like. I'd like to trade periods where the volume is higher. It doesn't really give me much of a bias. I don't look at, a super large green candle like this one that had large volume as much because, again, this was the end of the day. Like, you're going to get big volume when things happen. But when I'm not so focused on the larger volume bars, I am focused on the average volume. I'm looking for the periods where the volume does look a little bit higher than usual. Those are the periods of the day I want to trade because you're going to have like the lunchtime session when not a lot of people are trading. You're going to have a lot of little things like that. I want to be trading when the volume is higher just because I'm looking again for that volatility in the moves. Since you're trading things that overall only move a percent or two, like the indices every single day for the most part, you want to be looking for the periods where they are making that actual move. And if a lot of the times that move just comes from the gap up or the gap down at the open, that's when you want to be able to just wait until that reversal. That's why I talked about I don't really like to trade the morning session as much anymore. I like to wait until you get the afternoon volume. But that does change. When you're in a much easier market, the morning session for a lot of people is the easiest time to trade, myself included. You just want to make sure you're also lining that up with the market. So these are all the things I'm looking at when I'm looking for day trades on options. I'm looking at them all together. It's really a list of 10 tickers, like right over here. These tickers that you can see on the right side of my watch list. These are the main things I day trade. Apart from Clove, I don't really day trade that. Just have a solid group of tickers that you like to trade. I think large cap tech is the best in this market condition. However, there are other market conditions. When we had the meme stocks going crazy, that was a great opportunity for day trades as well. You still get some of those opportunities maybe once or twice a week. So you want to make sure you have a good basket of stocks that you can day trade. Also, another thing, when it comes to trading mid caps like Fisker and stuff intraday with options, the only time I like to do that is on green days for the ARK ETF. Because I feel like when you have a green day for the ARK ETF, that means, again, other people are looking at those types of stocks. And you want that. You want other people to be giving you money. It sounds weird, but that's really the only way you can make money in the market from a very literal standpoint. So if the money is headed towards those types of names, which does not happen as much as it used to, but those days where you do see a 4 or 5% ARK ETF, that'll be the type of day that I will be looking at maybe something like Coinbase or Roblox or Fisker or whatever types of those names to intraday trade with options. But apart from that, again, the movements are just too inconsistent with this type of market that when the ARK ETF is red, I just kind of look away from those stocks and focus on my large caps. So that's kind of how I go about the different baskets of options day trading. Sometimes as well, just like I said, for the ARK ETF, when Bitcoin is doing well, I'll look at Riot and Mara for options day trades. But again, when Bitcoin's just going sideways, it does not make a lot of sense for me to trade Mara and Riot. You want to be trading something when there's attention in that name. You do not want to be trading something that nobody is talking about. For the most part, that's going to be very hard to do unless it's a very standard ticker that's always getting volume, something like Apple. But like trading something like, I don't know, Carnival Cruises or UWMC or just super random names without any sort of news, without any sort of correlation to the market just by itself, because let's say you're just looking up random tickers and you're just looking for 5-minute patterns, you can get the most beautiful pattern on a 5-minute or a 15-minute chart on the randomest stock in the world. But the actual move is probably not going to be as favorable to you because nobody else is looking at the same thing. You want to make sure that other people are trading the same thing, again, so you can make money off of them. So these are all the little things I think about intraday. Of course, it does depend on the type of market you're in. I wanted to keep this like as more of a general guidelines because I've already talked about so many of these things before, but I'm just trying to kind of put everything together. So whenever I'm, let's say, busy and everybody wants to trade their own options or whatever it is, you can refer back to this workshop video and you can get an idea of what process you should be using to find your own trades. And that's really the overall goal here in Premium, to learn this type of stuff so you don't need me to be sharing alerts or whatever, so you can do it yourself and we can all help each other out. So this is really how I go about finding options day trades in terms of a very general summary. I'm going to end the recording now. I'm going to leave the rest of the workshop up to any questions in terms of things I just said.